Good morning, everyone. Hope you're up bright and early to join us. My kids have just gone out the door. Excuse me if there's a little bit of noise. I'm Adrian and co-founder of Hallcroft Advisory.
Good morning. I'm Martin Pollock, also co-founder of Hallcroft.
Please sit back and enjoy our conversation this morning. But before we do, those of you that have joined us before, it's been a little bit scripted. It's been a little bit death by PowerPoint. There still will be a PowerPoint in the background, but we've been listening to you guys. Please keep the feedback coming on the webinars. It really does help. After each event, a poll is circulated, and it does help us shape these events. You've left questions and comments that are really helpful, and we do honestly read them all. For example, today's topic is following a few people suggesting an overview post-COVID-19. The format is also a suggestion from a viewer that said, and I quote, "Can you make it more conversational, please?" Well, here we are. We're going to make every effort to make it a bit more conversational. I'm simply going to pretend I'm in the office with Martin having a chat. Let's hope I can get a word in edgeways. Just before I hand off to the great man himself, I need your help. Those that have attended before will have heard me mention bubbles that are on your screen. I think they're in your top right-hand corner. These help us communicate. One speech bubble is private chat. Only I will see that. 2 speech bubbles is an open forum. Everyone will see it. Please interact, ask a question. We're going to keep this short and sharp, between 20 and 30 minutes maximum, depending on the questions and how it's posed. We've obviously got a few things to chat about. Lastly, towards the bottom of your screen, you might have to scroll down a little bit. There's a few icons that I'll load up in a minute. Social media, sign up for our next webinar, and a PDF of who we are. Now, let's see who's awake. According to the national ecosystem, how much of the UK is covered in buildings? Sorry, I'm stalling there because I'm trying to set the time on this in the background. I'm going to give you 10 seconds. Away you go. Brilliant. Thank you very much. The answer is 2%. Surprising. Everyone actually, a bit of a mix there. People are voting afterwards. Are we allowed to do that? I don't think so. Martin.
Good morning. I feel like I'm a little bit of a silhouette because I'm sitting in my living room and it seems like the brightest of mornings. So hope you can see me, but certainly you can hear me. A little bit of a confession from my side. My guilty pleasure is sporting podcasts and actually also football phone-ins. Absolutely love them. Walking the dog, listening to them. And so I said to Adrian, we've got to make this much more conversational. I think people are probably going to get bored of just hearing the same old stuff about Hallcroft. So I'm not sure which one of us is Chris Sutton, certainly not me. And I'm not sure which one is Robbie Savage, certainly not me either. But we'll try and make it as informal as possible and hope you enjoy it. So I'll cover a brief introduction to Hallcroft Finance. Then we'll go into the deal clinic, and Adrian and I will give you an update on those matters. And then we'll have an open forum for questions. Please, please, please ask any questions you want at any time. We're ready for them. This is about having an open forum and trying to add value as much as possible. We're here for the next half an hour and longer if you want, but the aim is to get this done in half an hour. So, Hallcroft, I could speak for 25 hours about this business, but I'll keep it short and sweet. We are a 3-partner business. We have 2 sides to our business. And the first and most important part of our business for this morning's purposes is we are a property finance advisory business, and we advise developers and investors on structuring their capital stack by giving them the best options for debt and equity for their scheme, for their investment. The other side of our business is that we have an unregulated mezzanine fund, and that fund has grown significantly over the past 5 years, where we've been able to back our clients and other clients actually with second charge money, ranking behind challenger banks. And that business is something we'll cover in detail at a later webinar. The team, I'm not going to tell you top to bottom, all of us. I'm sure some of you know us, but I'll highlight Raymond Sykes. He is our chairman. He was formerly managing director of Butterfield Private Bank. He's an absolute star, more senior member of the team. I've not put this in age order, but I'll get a ribbon for that later on. And also we've got James Daniels, who just joined us. Excuse me. James joined us in the summer, and he as a data analyst, and he is an absolute shooting star, sharp as a tack, and he has a master's from Reading in real estate. One of my clients came to me the other day and said, I've got a commercial development which I want to fund, and I want to hold it for long term. Who should I speak to about that? Because I know you do residential. And I was shocked, because I speak to him all the time about what the deals that we do. We're a full service advisory business, and so we raise debt and equity for commercial landlords, commercial developers, resi developers. We have a full service. We've got a full set of products: student accommodation, retirement living. So feel free to ask us about any part of any of those products, and we'll do what we can to help you out. Another question to see if you're still awake. The largest town in Surrey is Guildford. How much area of Guildford is devoted to Greenbelt? Adrian?
10 seconds. Let's keep this short and sharp. We've moved away from the celebrity houses. We're trying to make this a little bit more factual this time. Well done, guys. The majority got that right. The answer is 88%. Great stuff. Okay, we're going to kick off to start off with. There's our quick agenda. This is for the conversation between Martyn and myself. Where have we been? What's happened? Where are we going? Martyn's going to kick off with where we have been, and then we're going to make it as conversational as possible. Martyn, away you go.
I'm not sure you can say we can make it as conversational as possible, because I'm always saying it's conversational, it seems less conversational. I think that might be the 10th time we've mentioned it. So where have we been? Growing specialist finance market after the global financial crisis. Very much thriving development finance market at 65% loan to GDV, serviced by challenger banks, investment funds. Pretty much 80-85% loan to cost, meaning for developers, any developers who are on our webinar, meaning they have to put in between 20-25% and sometimes 15% of cost. But when they were putting in 15% of cost, they were paying for it, and so risk being commensurate to rates, that was a more expensive way of doing things. Investment funds very much challenging the banks. Retail banks not at the table at all, and those investment funds who were challenging the challenger banks and not the retail banks, a key difference there. They would see higher gearing, maybe between 60 and 70%, but only for the best of developers. And mezzanine market coming in behind the senior debt was up to 75% loan to GDV. We saw a real push in the mezzanine market up to 2019, and then we had very limited equity opportunities in actual fact. And really we saw a couple of equity houses opening and failing between 2015 and 2019. So actually limited equity opportunities pre-pandemic. But after the pandemic hit, Adrian, what happened?
Yeah, well, it is important to look back what happened, just to remind ourselves. So looking back pre-pandemic, at that time, our business was just turning 10 years old. So it wasn't a startup, but like many, we were in shock. Our industry, like many others, was standing still, which every time I think back to those times, I have to force myself to think it wasn't a dream. Who remembers the election in late 2019 and the Boris bounce? That's a distant memory now, but we were starting to feel it. There was some green shoots coming out. We were looking forward to spring 2020. Little do we know what was coming. The pandemic put pay to all of that. And this is warts and all. You have to have a look at things and reflect back on them. We had a real stall between March and September. But what I will say, lenders really did rally around. Everyone was in shock that first month or two, trying to work out where we're going, what we were doing. One word that we used quite a lot was patience. No one wins when you fire when you're under real pressure and you're coming up with ideas and trying to move things along quickly. We really did just emphasize that we need patience. We had to think about what we were doing, how we were doing it, regrouped, and again, thank you to all the lenders and all the professionals that were around us. They were patient as well. They really did help. And what did we see? What happened? Towards September, October, the market rallied. I know there's lots of variables that we can go into that we've touched on there, government support, there were cost overruns. Of course, there were time delays. I think the construction industry did an amazing job keeping going. They were confused. Are we allowed on site? Are we not allowed on site? What signs do we have to have up? What plastic visors do we have to have? The health and safety went absolutely off a cliff. But what we did see is that the market did rally. Hopefully that gives you a quick idea of where we were, what happened. Where are we going, Martin?
Just before we touch on that, I mean, the resi market didn't rebound. It continued to grow in certain parts of the UK at a great rate. I mean, even now we've got a client who's just out of the ground. Actually, he's still completing groundworks on a multi-unit scheme outside Guildford, and he's already sold off plan 50% of the units. And the average sale price of these houses is about 1.85 million, and that's really not been seen before in this market. So I mean, it's an extremely buoyant residential market at this stage. So where are we going? You'll see a lot of this 70%, 75% loan to GDV. Well, what does that actually mean? We were sitting down with a funder recently who's been publicising 70% widely, and in actual fact, they're struggling themselves to fund deals at that level. And that's because, in actual fact, I don't believe the 70% product has actually changed from where we were before pandemic to where we are after the pandemic. The factors influencing the market is government intervention coming in. You've got Homes England coming in and funding some of the challenger banks and some of the investment funds. Similar to that, stakeholder funds are already invested in the market. Therefore, the investment funds, to some extent, some of the investment banks already have committed a return to a stakeholder. Therefore, they can't now compete on cost of funds. That interest rate can't go down, because if they're sharing with a shareholder, they still have to make the margin. They still have to keep the lights on. And so therefore, what do they compete on? Well, it's either geography and loan to value. And I'm pretty sure there's a lot of people who don't understand other parts of the UK, Scotland, Wales, for example. And so therefore, one of the only things they can negotiate on is loan to value. But what they won't be able to compete on is covenant of borrower and track record of borrower. So the track record of the borrower has to be A star, triple A star. They have to be able to demonstrate they've bought well, built well, and sold well. And they've done that a number of times, maybe 10, 15 times. Then you can start qualifying for that 70%. The 75% model is slightly different. This is actually a more exciting part of the market. This part of the market is where investment funds, more institutional money, is taking profit share with the small to medium investor or developer. And that's not something we've seen before. So you have got senior debt funds who were at 65% loan to GDV pre-pandemic. Now, after the pandemic, they're 65% loan to GDV, plus they've got a top up of capital where they share profits with the developer, something we've not seen in the market, and a real change and a different iteration to the specialist finance market, showing that it's moving and developing. So in actual fact, I'm less excited about the 70% model because I think it's harder to deliver because of the constraints at credit to get those deals done. And I'm actually more excited by the idea of 75%, and then as I mentioned before, the limited opportunities in equity investment pre-pandemic. Well, actually, if you've got senior debt providers who can take a slice of the equity investment and supply the senior debt, it seems like quite an interesting proposition, especially if a developer then can limit his equity investments to, say, 4 to 6% of cost, where previously pre-pandemic it might have been 15, 25% of cost. That's a completely different business model. I just touched on there growing mezzanine lender opportunities. Post-pandemic or during the pandemic, we did see a number of new lenders coming to the market. Now, what we're really seeing is a number of mezzanine players coming to the market, new mezzanine providers coming out of the woodwork all the time. That's a competition for us at Hallcroft, and we can learn from that, and we can also grow from that because there's more opportunities. But certainly the mezzanine market is growing all the time, and I think there'll be a bit of a competition here between the mezzanine market and stretched senior product. And previously that stretched senior product was 65%. The new stretched senior product is maybe even north of 70%, which will compete with the mezzanine. It's to what extent the senior can compete with a blended rate of a good senior and a good mezzanine provider, which in actual fact at 70 or even north of 70% loan to value, a good senior and a good mezzanine provider should give you a blended rate of between 9.4 and 9.6%, something like that, certainly sub 10%. So if you're seeing a stretched senior product out there that's above 70%, which is one lender, and that the cost of that, the coupon on that is over 10%, well, then you've got to question whether it's the right move, because you could have a better senior and a better mezz coming together to give you a better situation. Where's the oh, sorry, where you go?
Sorry, Marty, on that, I'll add to that as well. When we're looking at opportunities, which we're just about to move on to, you've highlighted a couple of really good opportunities there that are in the market. But what I would emphasize while I'm listening to that is look under the bonnet, really understand where that money's coming from. If people are spotting opportunities, whether they're mezzanine lenders, senior lenders, funds, banks, however, in whatever format they come in, make sure you look under the bonnet and find out where those funds are coming. What have we learned during the pandemic? The people that didn't panic were the people that had the right lines of funding. If they were under pressure from their investors, they then applied that pressure to our clients. Now, we didn't have many of those conversations to be had, but we know there are many out there that had those pressures. Of course, we had those pressures, but we dealt with them. Thankfully, we've moved through that period now. But that's the real key. As these opportunities come to the market, we've got to make sure that we look at them in the right direction with the right partners.
And what are the opportunities?
Yeah, as an investor, I suppose we've highlighted three things then: investor, property developer, funder. In no particular order, but across them all, I think the patience. Everyone needs patience. So as investors, where can we go? I think it's Warren Buffett has mentioned it many times. When others are fearful, buy. It's easier said than done. Martin touched on our Mez fund, which pre-pandemic was out to 20 odd clients, 15, 20 clients. Now, the speed that was repaid was unbelievable, but they will agree with us, they were given the space to do so. So as investors now, we're looking for those opportunities. So land is difficult to find. That's a whole new conversation in itself. That's a whole another webinar. Planning system, release of the Greenbelt. We touched on it with a question. When you see 88% of a town being reserved for green belts, there's a conversation to be had there. Some people are going to throw things at me there. They will not agree with that in the slightest, but that is a debate that's going on at the moment. So for an investor, I think it really is be patient, but there are opportunities out there.
I'd also add, in terms of it depends which way you want to look at an investor. You could again, I'm getting completely blinded here by the sun. I might get a suntan on this webinar. In terms of access to long-term money, if you're a commercial investor looking to buy maybe a high street lock-up shop, and you want to put a blue chip company in there, or maybe you've got a Boots or a Sainsbury's or Tesco or something lined up, and you think, can I get some long-term money on this? Previously, during the pandemic, no. Post-pandemic, not really. And now it's coming back to the market. Interestingly enough, the challenger banks who completely withdrew from funding anything on the high street are still completely dubious about main high streets, busy locations, and that's because they feel that if there's a Boots or a Tesco that's on the high street, and the small little one-man band coffee shops, which everyone loves in their community, they fold, then people are going to stop going to the high streets. But what they do want to fund, where they do want to fund a Tesco or a Sainsbury's or a Boots, is on secondary local high street locations where they see that there's real good opportunity there. So that is a investment opportunity for investors looking at the commercial space. In terms of property developers, the opportunities are huge right now. I'll quickly touch on where I see the risk. The risk right now is your materials are expensive, your labour is expensive, and your land's expensive. Therefore, your development margin is getting pressurised all the time. However, your ability to make return on investment is second to none right now. It's never been stronger. Your ability to run 2, 3, and 4 sites at once has never been stronger before. Your ability to raise funds from a number of different lenders is certainly strong. And from our side, from where we advise our clients, it's better to have lender diversity or have a number of lenders on your panel so that you can have a look and say, like, this lender potentially is not got the appetite I want. Now I'm going to switch to this lender. So if you've got a portfolio of 5 or 6 lenders, you're in a very strong position. I think now is the time for a borrower to have those options, and it's for funders and lenders to show their ability to work with their clients to do more deals. So for property developers, a larger portfolio of funders, I think, is essential. And for funders, there's more competition out there. So the opportunity for them certainly would be higher level of customer service to keep those borrowers within your loan book.
Property developers focus on finding sites. That's it at the moment. And I know that's easier said than done. It's probably harder than it's ever been in my working lifetime. Finding sites is very, very difficult, and finding the right sites. There is no doubt there's a housing shortage. That I think that is agreed across the board, but it's making sure that the houses go up in the right place for the right price across the whole range. And that's where the focus really needs to be. And that's our focus, trying to add value, bring opportunities to the table with our clients, and not just focus on the finance. The finance is very, very competitive at the moment. Martyn has his finger on the pulse. James has his finger on the pulse. Hopefully we all do, with regards to who's lending, what they're doing. And I'll reiterate there what Martyn said, have a range of lenders. Most lenders will actually encourage that as well. They don't want to be doing supporting the SME businesses, but they don't want to be doing every single deal. They want to be maybe doing 2 or 3 of them, but make sure that the client is also spread into another couple of opportunities as well with other lenders in the market. Should we touch on the funders, Martyn, just the opportunities there? I just saw funders flash up, and I was just thinking, what's the one thing? There are opportunities. Martyn's touched on them. The market is moving 70-75%. It is exciting. But again, I'll go back to that. We talk about it all the time, patient capital. Make sure that capital is coming from the right place, that when the development or the investment doesn't go 100% to business plan, there is patience and there is time to work it out with our clients. And again, I'll leave it on that note. Thank you to all the funders that have been patient.
There's one other thing, Adrian, to mention, and it's important. We stress this all the time to clients in terms of quality of funder. I mean, to be honest with you, we keep our levels very high. Any lender that we work with, any funder we work with, has to have a proven track record. Otherwise, we would never introduce them to our clients. Part of the service that we offer is the ability to navigate that market and understand who's good and who's bad. That said, I do know that some funders that we work with and we rate highly did augment their appetite during the pandemic Some of them stopped lending, some of them changed their loan to values. And so if you are looking at this thinking, great, 75%, let's go, just bear in mind that if things change in the market, those funders have their own stakeholders. Their own stakeholders may have certain reservations about the market, and therefore, if they change their appetite, you're going to have to be able to move with them. So certainly use what we can at the moment to make the best of it now, but bear in mind that if things do change, the funding package could change as well.
Let's wrap up, Martyn. We're gonna go back to the celebrity side. We've done the 2 factual questions. One last question before we sign off. You can rent this house, this Beverly Hills mansion, for $80,000 per month should you be in the market. Which celebrity would you be renting it from? Is it Rihanna, Elton John, Lady Gaga?
Adrian Cormican.
People are reading okay and hello. They've definitely found that. They've definitely found out it is indeed Rihanna. Everyone, thank you very much for joining us. We are past 25 minutes. There's a couple of questions that I'm just going to add on to here. Martyn's touched on it, but there was one question that's put in the private forum around build costs. They've just mentioned how topical they are at the moment. Martyn, you touched on it earlier when we were talking about the opportunity for property developers. Build costs, where you see they're going, what are you hearing out in the market at the moment?
What am I seeing in terms of what direction are they pointing?
Yeah,
I mean, so one of the biggest challenges right now is formulating a development appraisal when you cannot be specific on your build cost because it's a moving thing. Labour costs are still astronomical. Material costs are varying. Actually, some things we've seen sharp increase, like likes of cost of timber. Actually, we've heard that reduced recently, and so getting a handle on costs is really quite difficult right now. That again, I said it already. That coupled with land values and vendors having a really bullish approach to the value of their land is really pummeling development margins. And so what happens is that the senior lenders and the borrowers are going to have to take a view on the level of profitability of a scheme. So previously, I mean, some time ago, it might have been 25% profit on cost, maybe pre-global financial crisis, 25% profit on cost post-finance. Well, then once debt gets more expensive because there's more gearing available, then profit on cost will drop to 20. Now you're seeing 15% profit on cost as a fundable proposition, and anything between 10 and 15, if it's got that level of margin, then it would be a retention and wouldn't have any sales exposure. So look, there's a solution that fits all. It's just that it's so hard right now to place larger development projects because staff costs and materials are unquantifiable at the moment.
Yeah, I'll add to that as well. I've had the argument with valuers and quantity surveyors over the years when they instinctively, from a matrix, put in, say, £200 per square foot for a residential development. It used to make my blood boil. But I know that in the last few months, instinctively, I've put £200 per square foot into an appraisal when trying to work out an appraisal. Now, that may work out with a lot of contingency in it, but also it safeguards the client to make sure that they are going to be profitable at the back end and that they're paying the right price for the land when they're working out their residual valuation. So there is no doubt that build costs are difficult at the moment, but I'm speaking to a few people yesterday that are working on much bigger projects than ours. I'm talking about 900 homes, something we'd love to finance. It's a consortium between Chinese, American and UK developers. They're talking about next year flattening off. And you can imagine their margins that they're working with. 1% on £10 million worth of steel makes an awful lot of difference to their bottom line. So they are watching build costs like an absolute hawk. Martyn, we've hit 9 o'clock, half an hour. We promised no more than half an hour. So unless you've got anything to add, I'm going to say goodbye to everyone. Thank you very much for joining us.
Yeah, thanks, guys. Thanks for dropping by. Please come and join us in December as well for our December webinar.
Have a good day all. Thank you.
Thank you very much.